Disclaimer. This is the most crucial 48-hour window in global finance. I need you to pause everything you are doing right now. You must understand that what takes place in Tokyo on February 9th will decide whether your portfolio survives the next 6 months. You need to realize that the entire global financial system, the stock market, bond market, housing market, crypto market, all of it is balanced on a razor's edge, and that razor's edge is the Bank of Japan. On February 9th, the BOJ will announce its policy decision. They will either keep printing money or choose to raise interest rates. And that single decision, made by a small group of officials inside a meeting room in Tokyo, will spark a chain reaction that reshapes the global economy. This is not exaggeration. This is not fear-driven rhetoric. This is mathematical inevitability. Because Japan is not just another nation. Japan is the keystone. Japan is the foundation upon which 4 decades of global easy money have been constructed. And if that foundation fractures, everything comes down. Let me explain why Japan matters so deeply. Why a country with an economy smaller than California holds the power to destabilize the entire global financial system. Japan has been battling deflation for 3 decades. Since the asset bubble collapsed in 1990, Japan has been trapped in a deflationary cycle. Falling prices, stagnant wages, absent growth. And for 30 years, the Bank of Japan has tried everything to stop it. They cut interest rates to zero. Then they pushed them into negative territory. They printed trillions of yen. They purchased government bonds. They bought corporate debt. They bought equities. The Bank of Japan literally became the largest shareholder in Japan's stock market. They hold ETFs. They hold equity stakes in major corporations, a central bank behaving like a hedge fund. All of this to generate inflation. All of this to defeat deflation. All of this to reignite growth. And for 30 years, it failed. Deflation remained. Growth never returned. Japan stayed frozen in place. But something shifted over the past 18 months. Inflation arrived not from domestic expansion, but from external shocks. The energy crisis, supply chain disruptions, a global commodity surge, a weak yen making imports more costly. Suddenly, Japan is seeing 3% inflation, 4%, the highest levels in 40 years. And the Japanese public, after decades of stable or declining prices, is alarmed. Their wages are lagging, their savings are shrinking, their quality of life is deteriorating, and they are demanding action. They want the government to stop inflation. This places the Bank of Japan in an impossible dilemma. If they continue printing money, if interest rates remain at zero, inflation accelerates. The yen weakens further. Imports grow even more expensive. Living costs spiral upward. Political pressure intensifies. But if they stop printing, if they raise interest rates, they trigger the very deflation they have fought for 30 years. They crash the stock market. They bankrupt the government. They devastate the economy. Because Japan's entire financial system is built on the assumption of permanent zero rates. Once that assumption changes, once rates normalize, the math collapses. The debt becomes unmanageable. The entire structure breaks. Let's look at the numbers. Japan's government debt stands at 240% of GDP. That is roughly $10 trillion in debt supporting a $4 trillion economy. It is the highest debt to GDP ratio among major economies in the world, higher than Greece, higher than Italy, higher than any country not in the middle of war or revolution. The only reason Japan can service this debt is because interest rates are near zero. The government pays almost nothing in interest. But if rates rise from 0% to 1%, annual interest payments increase by $100 billion. At 2%, another $100 billion. At 3%, Japan spends $300 billion per year just servicing interest. That exceeds defense spending. It exceeds education spending. It exceeds healthcare spending. The government would be forced to either default or print even more money to cover interest costs. And printing more money fuels inflation, pushing rates even higher. It becomes a self-reinforcing death spiral. This is not hypothetical. It is unfolding right now. Markets are already pricing in rate hikes. Japanese government bond yields are climbing. The 10-year JGB yield has risen from 0% to 0.8% in the past 6 months. That may sound small, but in a system where yields were pinned to zero for decades, it is seismic, and the shockwaves are spreading. Japanese investors, pension funds, insurers, banks are looking at rising JGB yields and asking why they should buy US Treasuries yielding 4% when Japanese bonds yield 0.8% with no currency risk, or why they should invest in US stocks when Japanese equities are cheaper and the yen is strengthening. Capital is beginning to return home. Repatriation is underway, and this is extremely damaging for US markets. Japan holds $1.2 trillion in US Treasury bonds. They are the largest foreign owner of US debt. For 30 years, Japan recycled its trade surplus into U.S. treasuries, funding U.S. deficits and suppressing U.S. interest rates. That relationship is now reversing. Japanese investors are selling US Treasuries, not abruptly, not in panic, but gradually and quietly. Exposure is being reduced. Capital is flowing back home. When the biggest buyer becomes a seller, prices fall and yields rise. Rising yields mean higher borrowing costs across the board. Mortgages cost more, corporate debt becomes expensive, credit card rates increase. The U.S. economy is built on cheap credit, and cheap credit depends on foreign buyers, especially Japanese buyers, financing the debt. If Japan stops buying and starts selling, borrowing costs in America rise. And when credit costs rise, asset prices fall. Stocks drop. Real estate declines. Everything declines. But it gets even worse, because the yen carry trade is not only about US Treasuries, it is about leverage. It involves borrowing yen at near zero rates, converting to dollars, and investing in higher yielding assets. US stocks, emerging market debt, real estate, crypto, venture capital, private equity. The yen carry trade has been the hidden liquidity engine behind global risk assets for the last 15 years. During every crisis, every market downturn, the carry trade stepped in. Japanese investors borrowed cheap yen and bought the dip, stabilizing prices. It functioned as the unofficial central bank for global risk assets. Now it is reversing. As Japanese rates rise and the yen strengthens, the carry trade becomes unprofitable. The math no longer works. Borrow yen at 0%, see the yen rise 10%, and you instantly lose 10% on currency alone. If you are leveraged 10 to 1, the currency move wipes out all your capital. You face a margin call. You must unwind. You sell US equities, you sell crypto, you sell real estate, you buy yen to repay debt. When everyone does this simultaneously, it triggers a liquidation cascade. Prices plunge, margin calls increase, selling accelerates, it feeds itself. And early signs are already visible. The Nikkei has fallen 8% in the past month. Japanese banks are reporting foreign currency losses. Credit spreads on yen debt are widening. Yen volatility is surging. These are the warning signals. These are the tremors before the quake. And that quake is scheduled for February 9th. On that day, the Bank of Japan will announce its policy decision. They will either maintain current policy and continue bond purchases, or raise rates, even by just 0.25%. Depending on what they choose, trillions of dollars will move within seconds. If the BOJ holds steady, the yen weakens. The carry trade survives. Risk assets rally, but only briefly. If the BOJ raises rates, the yen surges. The carry trade unwinds, US stocks collapse, treasuries sell off, crypto crashes, everything falls. Because the liquidity supporting asset prices for 15 years vanishes overnight. And here's the brutal reality. The BOJ is trapped. If they don't raise rates, inflation worsens. The yen collapses. Citizens suffer. If they do raise rates, they trigger a global financial crisis and take the blame. There's no painless option. So how do you prepare? Cut risk, diversify, monitor the yen, look at Japanese assets, hold precious metals. Because February 9th is not an ordinary policy meeting. It is the moment Japan decides the direction of the global financial system. Watch this date. Prepare for this date. Position yourself accordingly. Because what happens in Tokyo will shape the future of your wealth. The countdown has started. The clock is running. If this analysis helped you, like the video, subscribe to the channel Economic Records and turn on notifications so you don't miss what comes next.